Is it still worth investing in AI? Will the bubble burst? AI is a story Wall Street loves. Hype-driven, unstoppable technology, exponential growth, endless profits. Nvidia, the company selling the GPUs that power AI, saw its revenue explode more than 200% year over year. In 2024, its market cap crossed the $3 trillion mark, making it the third most valuable company in the world. Microsoft is rolling AI into Office, Teams, and Windows. OpenAI is pushing its models into every corner of the internet. Everywhere you look, AI is painted as inevitable. Now, this is what you read on the news. But behind the headlines, there's a darker truth. A recent MIT study found that 95% of AI pilot projects fail to scale. They all look impressive in demos, but most never make it past the prototype stage. And yet the stock market is acting as if every one of those projects will turn into profit tomorrow. That disconnect between hype and reality is the classic fuel for a bubble. Not too long ago, we all had a taste of reality. In only a few days, over $1 trillion vanished from tech stocks, simply because Nvidia's sales guidance wasn't as explosive as expected, and because Microsoft's Copilot subscriptions weren't growing fast enough. That's all it took, two major players with a less than perfect quarter. If you have money in a tech-heavy index fund, if you own shares of Microsoft, Apple, or Nvidia through your retirement account, you are directly exposed to the volatility of the AI trade. This isn't just gamblers buying penny stocks. This is the market most of us rely on. And the scale of the bet Wall Street has put on AI is massive. According to McKinsey, global AI investment is projected to hit $200 billion by 2025. Entire sectors, finance, healthcare, retail, are pouring money into AI pilots, tools, and infrastructure. But the same research admits that real productivity gains may take years to show. In other words, the spending comes now, the payoff comes later. That gap is where bubbles form. History gives us a precedent. In the late 1990s, the internet promised to change the world. It did, but not before the bubble burst. Between 2000 and 2002, the dot-com crash erased $5 trillion in market value. Thousands of companies disappeared. But a few survivors, Amazon, Google, eBay, emerged from the rubble stronger than ever. If you picked the winners, you became rich. If you held the losers, you lost everything. AI today feels eerily similar. The valuations are sky-high and the failure rate is hidden in plain sight. The money pouring in is several times bigger than the early internet. Even Sam Altman, OpenAI's CEO, admits it feels like a bubble. But like the internet, he says, the survivors will change everything. They will literally run the planet. So, is AI still a good investment? The answer depends on your horizon. In the short term, the risks are obvious. Stocks tied to AI are priced for perfection. One disappointing earnings call, one regulatory setback, or even just a slowdown in enterprise adoption could trigger a sharp correction. We've already seen the trillion-dollar dip. That could happen again, and harder. But long-term, the story is different. Unlike fads, AI is not going away. Just like the internet, the technology is real. It's just the timeline and the winners that are uncertain. So what should an everyday investor do? First, don't confuse the technology with the stocks. AI will reshape the economy, but not every AI company will survive. Second, diversification matters. Instead of chasing hype stocks, broad exposure to giants like Microsoft, Apple, or Google may be safer, because they can weather volatility. And third, expect turbulence. If you buy into AI now, understand that corrections, crashes, and bubbles are part of the journey.